Hey there, it's Joshua Bellinger here at OptionSizzle.com, and in this short video I'm going to respond to a comment that was left here on one of our recent posts. And the post here is called Why You Should Avoid Trading Options Altogether, and you can find that coming to OptionSizzle.com and clicking under articles, and it will be listed under there. Now what I want to do is I want to scroll to the bottom here where the comments are, and you can see the other video that I created for another individual. For the video today, we're going to answer Andrew's question here, and a little bit of it is asking about the idea of selling puts on stocks and the what if the stock goes lower and we get put the shares, or if it goes to zero. So just looking over the question here really quickly with you, one of the things that we talked about in the article was selling puts on stocks that you'd like to own. And from his experience above in the previous paragraph, he talked about the fact of what most people usually do is they buy options and trying to pick direction. But the aspect to it is that there's a lot that goes into trying to pick direction, especially with options. And what he said above here is that he really didn't see, he was in the red because of that. So the idea of selling puts or selling options is a more viable outcome, and that's something that I talk about in the previous video here, answering Shomik's question here. And that's what I talk a little bit about in this video as well, about the idea of using higher deltas and also using and selling options to create higher probabilities of success. So in this example, Andrew's question, and I'm going to answer Andrew personally here, that he's asked, with the margin requirement, it is about 20%, and that's correct. Now, if you're in an IRA, it's what's known as cash secured, meaning that you have to have all that cash held for it. So in an IRA account, you're not able to have any margin. In a traditional account, you're able to have a margin, and that's where that 20% comes from. And that's where the leverage and that kind of stuff is really advantageous. Now, the thing is that when you are managing positions and when you have certain things on, obviously, if you're selling the put and in theory looking to own those shares, you want to make sure that you manage your risk from that position. So what you would look to do is that you would want to make sure that you don't have an equity size that is more than 5% of risk in your position, and that's with selling the puts and also looking to take on a position. Now that's just a rough thumb, or that's a rough number, but ultimately you don't want to have too much risk, because what you asked about a little bit later in this question here is that you would have, let's say, if there is the theoretical risk, and that's why options have the premiums that they do. The probabilities are what we look at, though. And what most people look at is the theoretical. Well, this stock went out of business, or it went bankrupt, and it's very far in between of this happening. Also, the time frames that you're in as well. So it's almost like you're just jumping on trains if you think about this. And obviously, you just don't want to get on the train that gets stuck, and that's part of investing. Those things will happen. Having that happen to you, that's what you want to avoid, and that comes with a little bit of luck. Ultimately, the probability of that happening to you is very, very low. However, there is the probability of that happening. Even though it's a high probability of success, there is that probability of that loss or something, a rare event, a black swan event happening, or you get into that position and you're not familiar with the company. Let's say we look at JCPenney right now, and you try selling puts in that. Well, at this point, there's a lot of talk with JCPenney going bankrupt. There was an opportunity to sell puts in that one, but you would kind of want to stay away from a name like JCPenney that has that risk or that talk about of bankruptcy or something big happening. There's many more opportunities out there, and there wouldn't be a reason why you would want to go in that one. That one's kind of, you're taking on a little bit too much headline risk, and you would anticipate, and maybe your thoughts are they won't go bankrupt. That's fine, but for me, I would steer away from that because there is a lot of talk about it, and I could find other opportunities. So looking at the last part of the question here, and I'm kind of a little bit confused on it, but I think it's more about just getting exercised, and it really goes into the overall approach. Now, if you're looking, and the reason for the article was just to highlight the fact that you should be using options in one way or the other. I have a lot of investors that tell me, I don't want to learn stock, or I don't want to learn options. Well, the scenario is that that's fine. You don't want to use options, and you just preferably use stock, which I think is still still a disadvantage. I mean, the purpose of options are to provide the most and provide an opportunity and a higher opportunity of success. But even some investors still do not want to learn options, even though they could become much more successful and make greater returns. They just feel that owning stocks is something that they're comfortable with. Yeah, that's with them, and I could debate them all day and explain to them all the benefits, but some just prefer to use stocks. Using this, and there's two ways to look at it. If you're looking to get into a stock, you use puts to enter in at a better price. If you're looking to sell puts and just look to sell that to collect a premium, well, then you would look for opportunities to take adjustments when they're needed, and not really looking to take on that extra risk. This is much more beneficial when you have a larger account, something that's, let's say, on margin portfolio, because you can theoretically, if you're not familiar with adjusting, or you're not comfortable with it, or don't believe in it, you could theoretically take those shares, and if you manage your position, what you would do when you sell that put, because you want to anticipate that I might have to take these shares. So you don't want to anticipate when you sell those options that this is going to be 50% of my account, because that's not what you want. You have to manage the position on your overall account from the beginning of that trade or that investment. And that begins with proper risk management and position sizing. So we know that one contract is equivalent to 100 shares. If that is still too much for you, there's certain options called mini options that provide some opportunity with one of those contracts equals and is equivalent to 10 contracts. So ideally, when you're looking and you have a smaller account, or you're looking for opportunities to sell puts, you want to look at opportunities that are low-priced stocks. I would say probably anywhere from $10 to maybe $75. You can look for those opportunities, and maybe 100. When you start getting over 100, that's where it starts to require too much capital, and that's not where you would want to look. Then you would look to utilize some kind of put spread or call spread. So if you have any questions, let me know. And thank you for watching the video. Thank you for taking the time to leave the response, and I appreciate it. After you subscribe to the channel below, make sure you head over to optionsizzle.com and download my free report on how I outline the process of finding options that are on the verge for explosive moves.